Good morning, everybody. It's Herb Morgan, Senior Managing Director, Chief Investment Officer here at Cantor Managed ETF Portfolios. This is my weekly economic and market commentary. You can follow me intra-week on LinkedIn, just Herb Morgan, please do, or on X at ETF_strategist. Presentation has been prepared by me. It is designed for use with both investors and financial advisors, but each are expected to make their own investment decisions. Nothing in the report should be treated as investment advice, tax advice, a recommendation to purchase or sell any security. Everything is for informational purposes only. The views expressed herein are mine and mine alone, and they may differ from the views of CFIA's parent affiliates or other portfolio managers here at the firm. We had a really great week in equity prices last week. As you can see, S&P up about 4%. That's the S&P 500, and is now just 0.75% off of the all-time high reached back in July. Year-to-date numbers 19. Now, as you know, the S&P 500 is a big capitalization or large capitalization index. It is dominated by technology companies, very different from when I started in the business in the 80s. It was dominated by energy companies. And 150 years ago, it was dominated by railroads. Things change. Well, I shouldn't say, yes, dominated by the stock market was dominated by railroads back in the 1800s. Fixed income also caught a bid. What's interesting about this results here and the rebound from that summer correction that we've seen is that the NASDAQ is still 5% below its all-time high. The S&P 500 roughly equal to its all-time high. What does that say? It says the market's broadening out. And broadening participation in the rally is not only a good sign and a healthy sign, but it would lend to the argument that we're not about to enter into any kind of a recession anytime soon. And it would help with the Fed's argument that they're trying to engineer a soft landing. We got some economic data last week. Let's start with July's report on consumer credit. They said consumer credit grew $25 billion. That's way more than a double the estimate. And it was fueled by what we already know, which is a big retail sales report in July that was very positive. However, we're also starting to see one of the reports that comes out of the Federal Reserve is a report on credit card delinquency. That says that the consumer is starting to struggle. Now, is the consumer struggling because the economy is slowing, or is the consumer struggling because of the inflationary pressures, food and household goods, those kind of inflationary pressures? I think that's the case as opposed to an overall slowing of the economy. Moving on, the National Federation of Small Independent Businesses put out their Small Business Optimism Index for August. It fell again, and you can see, you go back here to 18, 19, we're at this 105, 108 level. We've been bumping along this 90 level. Last June, July, it started to pick up and then come back down here, 91.2. That was below the consensus estimate of 93.6. And it was a pretty sizable decline, largest decline we've seen in about 2 years. The people that responded to the survey said their outlook for the economy and the outlook for sales for their businesses both contributed to that lower level of optimism. Now, we got some inflation data last week. It was very important because we got the CPI and the PPI both ahead of this week's Federal Reserve FOMC, Federal Open Market Committee meeting. This is where the voting members of the FOMC get together, sit down, discuss the economy, look at the reports from the different districts, and decide on policy. The most important of those policies is probably the federal funds target rate, followed by balance sheet runoff and reduction. So some important data that they got, same time we got, maybe they got a little sooner, I'm not sure, is CPI, Consumer Price Index. The August Consumer Price Index was up 0.2%, right in line with expectations, and up 2.5% from a year ago. The core, unfortunately, was significantly higher than the 0.2 estimate, was up 0.3. When you annualize that out, that's almost 3.75% inflation. Core, the Fed's core target is 2%. Yet, they're widely expected to cut interest rates to try to get ahead of. They believe that this number, even though it was a bad month, will continue to come down. I'm not sure I agree, but that is the thinking, and that is why it is likely almost certain that the Fed will cut interest rates by at least 25 basis points this week. As I look through that CPI report, I see where the inflation is coming from. It's the core services component. Back in June, it rose at 0.1%. In July, 0.24. That's more than a double. And then in August, it accelerated further to 0.31. This could be problematic for the Federal Reserve. Their view is no, we have a downward trend. We can stop focusing on the interest rate piece, and we're going to move and sort of focus on our employment. We want to cut rates before the higher rates start to impact employment, and we see employment reduction in the United States. So they think they've got the inflation mandate in line. I personally don't think they do. I think it would be more wise to wait until their November meeting or even December. And the other reason for that is, of course, this is the last meeting ahead of a presidential election. In the Fed, it's very important to the voting members of the Fed to not be seen as political, to be seen as completely independent at all times and not helping or even perceived or even having people suspect that they may be helping a party or a candidate, the incumbent. That's another reason for them to wait. They are not going to wait. I believe they will make that cut next week. August producer prices were also reported in line with estimates, up 0.2%. The core also was higher than the estimate, 0.3 versus 0.2. The year-over-year number, though, was in line at 2.4. So remember, Fed's target for core inflation is 2%, and we are above 2%. Weekly initial claims for unemployment has just bumps along at this incredibly low level, 230,000, right in line with the estimate of 226,000, a little bit above. Continuing claims are still very low at 1.85 million. This is, population 335 million, a workforce 155 to 160 million people. So if their mandate is full employment and price stability, we're at full employment. I get it. They're trying to turn a ship. Ships don't have brakes. We're in the water. We're moving. They think their past policy actions will continue to bring back down inflation. But I just personally think that it would be more wise to wait. And so this is what our Bloomberg terminal is telling me in the World Interest Rate Probability, WIRP. As you can see, current Fed funds target rate, based on futures and betting, they're expecting by the end of the year, we're looking, here's 5% right here. Whether we go to 5.25 from the current 5.5, or we go all the way to 5 this week is on the table. I think it's 50-50. But given the two inflationary reports, I would encourage to be more conservative and just go with the 25 basis points. But as you can see, the market also expects the Fed to continue to cut interest rates as we move into the end of this year and then into 2025, where we down would be a long run, more normalized Fed funds rate of around, let's call it 3% from the Fed 5.5% that we're sitting at today. We also got the month of September's consumer sentiment report from the University of Michigan. They say the consumers felt a little better, rose to 69 from 67.9, about in line with expectations. One of the reasons there, we're seeing energy prices, we've seen gasoline prices come down, and that's helping consumers a little bit. Current conditions rose a little bit to 62.9. Expectations rose a little bit as well. But as you can see, look at how the consumer felt here. So basically 10 years kind of bopping along just under 100 or just over 100. And now we bop along here in this range of 65, 70. And that's just lower. And that's been going on, as you can see here, since the beginning of COVID. And so we really are focused on this discussion of inflation. And I thought I'd just give a brief, kind of simplified primer, if you will, on inflation. And inflation essentially is a form of taxation. It's a form of taxation that's not explicit. It's not voted on by a Congress, it's signed into law by a president. And inflation definitely affects and impacts entities, organizations, and individuals. And in a sense, it can be a form of taxation and redistribution of wealth. And in its purest form, inflation redistributes wealth from lenders to borrowers. So inflation is a reduction in the value of a country's currency, i.e., how much it can buy. When I was a child, a dollar could buy 2 gallons of gas. Today, a dollar buys in California a sixth of a gallon of gas. As an example, everything costs more in dollars. Inflation benefits some and it has a negative impact on others. So if you have a high level of debt and you're paying back that debt over a long period of time, such as if you're a big corporation or somebody who owns a very valuable and expensive home that carries debt on it, inflation might benefit you. Younger homeowners with large mortgages, inflation would benefit you because your payment stays the same, and over time, your wages would catch up, and the value of your home in nominal dollars would go higher. Corporations with pricing power, fixed debts, and high levels of revenue that can be adjusted to CPI would benefit. Benefiting, the more debt you have, the more you benefit because you're repaying that debt with future dollars, with deflated dollars. Governments, obviously, the United States is a very large debtor. We're talking $30 trillion of debt, and inflation would benefit the United States Treasury significantly and substantially. And investors, wealthy investors who own large pieces of real estate. Real estate's a great hedge against inflation. They'd benefit, especially if they carry debt on that. And companies, as I said earlier, with pricing power. So who gets harmed by inflation? People without valuable real estate assets that are secured by large mortgages would be harmed trying to get in for the first time. Inflation really harms people who are not yet homeowners, people who've maybe paid off their mortgage, older people who are living on a fixed income, people with incomes that are less likely to rise or to rise more slowly. Maybe they're in an industry that can't just raise the price of everything. And it's very challenging. If the price of everything goes up, but you can't get higher wages, you're harmed. One way to say that is that inflation harms poorer people more than it harms richer people. People that live off of fixed incomes, people that have invested purely in bonds are harmed by inflation. Annuities, certificates of deposit, treasuries, you're harmed. People without large stock portfolios. If you own Microsoft and Apple and Google and these great companies, and through ETFs, the S&P 500, and these companies have the ability to raise their prices along with inflation or even more, you could benefit. But if you don't own those, you're harmed. And it also harms the overall economy because capital likes to go where it believes it is safe. Is it protected by a rule of law? Are contracts enforced? Is the money I put into an economy safe from the ravages of inflation? So a country needs to maintain its credibility in that regard. And so that's why the U.S. is trying to get its inflation rate down. The Federal Reserve is trying to do its part to make that happen. Okay, in terms of economic data this week, we're going to start with New York State Manufacturing Survey this morning, Monday. The consensus is still negative. Interesting, a couple of days ago, that consensus was above zero, and I thought it was going to turn around. But by the time we gathered the data on Sunday, that had turned negative again. August retail sales expect to go down a little bit. Industrial production and utilization. We've got the housing market index. The estimate is for 40. Anything below 50 is not good for the housing industry. So we know that. That's because of rates. That may change as rates come down. We've got starts and permits on Wednesday. But the most important, by far, piece of information is going to be what the Fed does with the Fed funds target rate, and more importantly, what the Fed says about the likely future path. We've got initial claims on Thursday, as we always do, Philly Fed, existing home sales, and really nothing scheduled on Friday. Thanks, everybody. I'm around. If you have questions, comments, or concerns, please let us know. Please hit the like and thumbs up button here on the YouTube channel. We're We're also available audio only on all the different podcast formats. Thanks again. Back to you again in 1 week.